you can always get your money back from Apple. Maybe not next year, but in 10 years. But if a medium form goes down, it goes down. So that'll create a credit crunch. And bond market is already saying signals. Okay? You can, there is still, oh, let's look at the effect of this on Tesla. This is pretty much, I mean, it went up today, but this is pretty much self-inflicted on Elon Musk. Let's look at the last 3 months. Tesla shares lost 40% of their value, including the 8% increase today over the last 3 months. Elon Musk is not the majority shareholder. He's not the god of Tesla. And he's probably one of the biggest shareholders. He himself lost around $150 billion in wealth. I don't even know what Twitter is worth now because everybody started boycotting it. So market is already giving the messages. They say, we do not like what you're doing. Again, politically, you may agree with them or not. That's a separate issue. But market gives you a simple message. And let's look at just year to date, 36%. Even, let's look at this stock, DJT. This is Trump's media and technology company. As you know, there are a lot of rabid Trump supporters. They actually buy these things and support Trump for whatever their own reasons they do. Just year to date, they lost 41% of their investments. And this is a relatively biased set of investors. For example, unless I see this very cheap, I will never buy this. I happen to be a liberal Pinko-Kami liberal Pinko-Kami, but if I also see the chance that I can short it and make money, I will also short it, but I don't want to have to duke it out with irrational Trump investors. So I typically stay away from it, which means in opinions like mine, right or wrong, are underrepresented in a stock like that. Despite positive opinions being overrepresented, this thing is down 42% year to date. So always look at things what market tells you. It gives a message. Doesn't mean market is always right, but there's always a good reason. You can also read the tea leaves. Inflation came relatively low yesterday. For example, let's go to CNBC.com. Oh, I'm going to actually look at a different thing. There is one statistic this database keeps. It's called the break-even inflation rate. Five-year break-even inflation rate. This is essentially, if you look at the yields of nominal U.S. Treasury securities, and there are inflation-protected U.S. Treasury securities tips, at the break-even rate, expected return on both of them are right. When market thinks that inflation is more likely to go up, break-even inflation rate goes up. At the end of the year, that number was 230. Currently, it's 250. This is despite having a low inflation number in February. Any effects that tariffs are going to have inflation They're not going to reveal themselves in the data for another 3 months, but these things are going to keep going up. Let's see. Let's. Oh, if you type Fed Watch tool, CME has a little website. It basically tells you based on futures contracts on Fed funds rates what market thinks Fed is going to do. I'll let you guys go after this. For example, next meeting is next week. Next Thursday at 2:30, Fed is going to make an announcement based on the prices. Uh, market is attaching a 99% probable that nothing will be done. But that number was different. Let's look at longer meetings. For example, let's look at the end of the year. Okay. Obviously, there are many meetings in the meantime. Basically, market thinks that there's going to be somewhere between half a point to a point more drop in Fed funds rate until the end of the year. Let's see what those numbers were. For example, the chances of half 1 point drop right now is only 20%. Okay. And 1 month ago, oh, it was a little bit higher. Or the chances of everything staying the same, uh, yeah, the market is concerned. Okay. Because why uncertainty increases? When the only reason these numbers are a little bit low, people are concerned about potential recession. And if there is a recession, Fed is a lot more likely to decrease interest rates. That's one of the reasons 1 month ago, chances of interest rates staying constant was 30%. Now it's about 1%. Market thinks there's a potential recession. You could also look at things like, let's look at the yield curve. Let's see. Markets. Let me make this a little bit bigger. Now let's look at it. 2-year US Treasuries are trading around 4, 3 is similar, 5 is similar, and 10 years is not that high either. Okay? In fact, relatively speaking, look at from 6-month yields 4.25 versus 2-3 year. Yield curve is actually on that portion downward slope. That's called inversion of the yield curve. That means market is thinking that short-term interest rates are likely to go down in the future. That's typically a concern for recession. You can read that stuff off. I mean, normally, by its very nature, yield curves tend to be upward sloping. Because why? If anything, there is more uncertainty about future inflation and interest rate risk of longer term securities are higher. So you need compensation for those. So despite that, I mean, there's not much interest rate risk on 6-month bonds, but you know, they're yielding higher than they're yielding almost the same as the 10-year rates. Technically, there should be at least 1 point difference between them as a compensation. It's not there. That means market is saying we're going to keep things safe. We're not going to take that risk. Okay, I'm kind of beat up. Let's stop here. Have a great break, and I'm going to post up stuff, right, guys, before you guys come back. We'll do our regular quizzes and stuff. Let me see what chapter we're going to do. If I'm not mistaken, yeah, we're going to start with chapter 9, all the interest rates and stuff. And rest of the schedule is going to be the same as we planned after the spring break, provided I don't have any setbacks. Hopefully, we won't. And I'll see you guys in what, 12 days. Take care, guys. I shall. I'm going to rest quite a bit.